And welcome to this week's Shoot the Moon podcast, broadcasting live and direct from Revenue Rocket World headquarters in Bloomington, Minnesota. If you tune in regularly, you know that Revenue Rocket is the world's premier growth strategy and M&A advisor for tech-enabled services companies. With me today are my partners, Matt Lockhart and Ryan Barnett. Welcome, guys.
Good to be here, Mike. What do we got going on this week, Ryan?
Hey, Matt. Hi, Mick. Yeah, thanks for joining us this week. We're always talking about things that are on our mind and things that we're dealing with on a daily basis here at Revenue Rocket. And in the M&A world in which we work on, we're talking with companies all the time who are really looking for premium offers for their tech-enabled services business. So today, Mike, Matt, I'd love to hear your take on what does it mean to get a premium offer in this market. And if we look at a company, what kind of things can a company work on to help get to that premium offer? So Mike, why don't you set us up on the highest level, typically how are deals valued in the tech services space, and just get us going on this topic.
Yeah, sure thing, Ryan. So certainly deals are valued throughout the tech-enabled services space on a multiple of EBITDA or profit. It's important to optimize that profit as a percentage of revenue in order to command a premium. That's not the only thing that'll help you command a premium, but certainly that is one. You're going to want to grow your business at a nice cadence every year, and hopefully within the top quartile of your peers from a growth rate perspective and from a profit perspective will help command a premium. Obviously, a mature business, with systems as it relates to processes and staffing, will also help command a premium. And I think depending on your thoughts about how you want to proceed in the business, whether you're selling in or selling out and how you present your role, both pre and post transaction, will help to, there's various nuances there that certainly will help you command a premium as you go to market.
Okay. And Mike, if I was to back up a little bit, I mean, if you look at how valuations are done in this space, what's a typical metric someone's going to look at for just to give a big range of ideas here?
Yeah, thanks, Ryan. Essentially the multiples range probably from 6 to as high as 11x trailing 12-month EBITDA, depending on the size of your firm, the focus of your firm, the amount of recurring revenue in your firm, and frankly, some of these other things we mentioned earlier in the podcast as it relates to how you're operating the business.
Yeah, and I think that's the bulk of what I want to jump in here, Mike. So thanks for setting the stage. If I heard you correctly and parroted it back, typically we're going to see an offer is going to come in that's based on your EBITDA, your adjusted EBITDA. And that offer can be a big range from we've seen buyers that might lowball something in a very low range of 3 times EBITDA, and buyers on the other end that, if you've got a large diversified platform, could be well above market of where they're at. So today you really want to hack into some of these things and some of those questions that we've got around if you're trying to sell your firm, what things should you focus on? So Matt, why don't you get us started on, you really focus on a lot of sales, marketing related efforts. Can you get us started on what kind of growth is needed to receive a premium type offer?
Yeah, sure, Ryan. Obviously there's not one answer here. There's a bit of a dependency upon what type of business it is, the recurring revenue levels, et cetera. But needless to say, demonstrating organic growth, right? So that's non-acquisitive growth, is absolutely critical in receiving a premium offer. And the growth rate again can range a little bit between sort of sub-industry within tech services, but at sort of a bare minimum, I think to be thought of in the premium category would be 15% growth rate, and that's in the case of sort of recurring revenue businesses. If you're looking at a mix of business or revenue types, recurring, non-recurring, et cetera, then, I think that it's a good baseline number to have in place would be 20% year over year growth rate. And if you want to really get people's attention, that you've built a premium sales and marketing go to market. You've got the wheel nailed, and you've been able to demonstrate that you can do that on a year over year basis, and you're somewhere in between 20 and 25% growth rates, or above 25% growth rates on a consistent basis, then you're certainly going to be getting people's attention, because investing in businesses like that and expanding upon the great work that has been done in that growth business, I think is super appealing.
I think that thanks for Matt. The higher the growth rate, I think the better the multiple is the general consensus. Reasonable growth that is proven. I think that's a big part. If you look at, for example, a forecast that has a hockey stick growth, that's going to be questioned by buyers. So understanding there's a proven history of growth is certainly one way to help increase the multiple. Mike, we talk a lot about the rule of 45 and how growth and profit come together. If you've got essentially the rule of 45 is your revenue, your growth percentage, plus your EBITDA percentage should be around 45. Mike, how does profit and profit percentage, either on a gross margin or an EBITDA percentage, how does that impact getting a premium offer?
Your profit as a percentage is important in your business. Certainly, you'll want to be in the top quartile of your peers, and in order to command a premium. And I think in our industry, the best performers are performing north of 15% EBITDA. Certainly, we see firms perform north of 20% EBITDA, 20, 22, 23 tends to be a top, I don't know, I would say 5% of the firms in the market perform at that level or above. Unless you've implemented sort of what I would call new technologies around AI that disintermediate labor, it's very, very difficult to get above 22, 23% EBITDA. So certainly more is more when it comes to looking at a multiple on EBITDA. Very profitable firms that are growing will command the highest valuation.
And if you think about that margin profile, more profitable is better. Matt, is there a kind of an absolute size? How does just a pure relative size of a firm in revenue and EBITDA, how does that start to look at that the offer structure or the range of perhaps an EBITDA analysis here?
Yeah, again, and I hate to do it, Ryan, but a bit of qualifiers based upon the submarket, right? So, for example, in the MSP marketplace, for example, I mean, there has been so much activity. There's been so much consolidation that, the levels are becoming pretty well understood, right? And premium, and maybe characterizing premium as being a double-digit multiplier opportunity, really are going to exist when you're probably north of $4 million of EBITDA. And now that's not too far off of the general tech services marketplace, but some specialty offering firms, be it cloud-based firms, et cetera, could be a little less than that in EBITDA, if they're truly specialized. The more generalized and the more sort of project-related revenue, non-recurring revenue, then you're going to need to get into those higher single-digit EBITDA numbers, right? 6, 7, 8, even $9 million of EBITDA, until you're going to get into that super premium category, I think.
So having that growth, that organic growth, paired with the profitability and paired with an absolute size is just some of the foundational metrics that we're talking about. Mike, how does a company's target market play into this? And when I think about target market, I think about the geographies they serve or the niche industries that they might go into. Are firms that are specializing or have a centralized focus, are they getting premium offers?
Absolutely. Firms that are verticalized and tend to be more broad from a geographic perspective tend to get a premium offer versus more of what I'll call a geographic generalist. We've seen that over the years. It certainly continues to be more important, particularly if someone's building on a thesis around that vertical market or an adjacency to that vertical market. It can command as much as a 1 to 2x EBITDA multiple premium with everything else being equal based on what we've seen. And so, we've long talked about the value of verticalization. Certainly there's a reduction in competition for verticalized firms typically, and typically they tend to operate at faster growth rates and higher EBITDA margins. Couple that with a EBITDA premium being paid for those with the right buyer, certainly all of that adds up to getting an optimal offer.
So if we've got growth here and we've got EBITDA percentages in size, Matt, and we've got focus again on a market, how does the team structure need to look and I'm focusing here on really sales and marketing, perhaps the team structure and the processes in place to help create that growth engine. How much does a firm need to really invest in that those growth functions to help facilitate that premium type offer?
Well, I think that our listeners probably have heard the term, platform, right? In the view of a business as a whole, right? So, but I think there's multiple sort of sub platforms, right? That create the foundation that enable a buyer to see a firm as as a high growth business, right? And as we talked about, having that demonstrated capability and demonstrated history of growth is critical. But a buyer needs to see that foundation is in place that allows, continued investment and to be able to maintain and or accelerate that growth rate, right? So certainly having key leaders in sales and marketing, be it a chief revenue officer or simply senior vice president of sales and marketing, but again, demonstrated leadership and thought leadership in the role, as well as the appropriate subject matter expertise as it pertains to the market, the offerings and the positioning, what customers are interested in. And then from a sales perspective, again, having the demonstrated experience in, driving the wheel. And when I say the wheel, the flywheel, right, the execution wheel, so that there is new client acquisition, there's existing client growth, and again, a sustainable and accelerated growth rate in the business.
Yeah. And so if a firm is really able to generate that growth and be able to bring on customers, Mike, how does the role of recurring revenue and customer retention start to play in the valuation process and getting a premium offer?
Yeah, great question, Ryan. The quality of the revenue is critical. And when you think about someone looking at the business from the outside and being able to come in and play a role, they want to know that you have a history of taking care of your clients and continuing to grow the business. They also want to mitigate risk, and they mitigate risk by seeing that there's not significant customer churn, that if you have recurring revenue and long-term contracts, that creates an additional barrier to exit. And ultimately, looking at in general how satisfied the customers are with the business, but also the trajectory of those trends over time. That gives them a lot of comfort and can absolutely contribute to a premium offer. I think if you have, and it doesn't matter really, certainly it's easier, I would say, to create a recurring revenue model within what we traditionally call managed services companies. But for application companies, custom development shops, AI development, folks that implement applications, business applications, certainly there's an opportunity to, build your revenue model around recurring revenue. And the more you can do that, particularly get those numbers 50, 60, 70% of overall revenue, that creates a lot of comfort in buyers' minds that, that's a higher quality, sort of higher value contract, and that there's less risk in assuming that business, that business is going to go away. And so there's several moving parts here. One is the recurring contracts, but also the repeat revenue and customer churn. You want customer churn to be low, you want repeat revenue to be high, and if you've continued to grow the business up and to the right and sprinkle in a high recurring revenue percentage, then certainly all those things add up to premium value.
No, it's great advice. I think the number we oftentimes see is above 60 to 70% recurring revenue is where premium offers come in. And customer retention and churn also plays a big part in that analysis. Matt, you've done a lot of work here when it comes to the actual contracts and revenue contracts themselves, especially when it comes to managed service providers. Can you just touch on how those contracts may impact an offer? And maybe even the case where there isn't, there's a lot of handshakes in our industry. And I think we've seen great businesses built on some handshake relationships. But how does the contractual relationship of customers impact the offers that people may be getting?
Yeah, in a recurring revenue business, obviously multi-year contracts with an auto renewal clause is sort of the premium. That's the best. And most, I think, MSP providers typically work on a 1 year with an auto renewal as sort of a baseline for a best practice. And many are attempting to move their customers, but I think that's where that sort of premium comes in, is it's not always easy to move customers into that multi-year scenario. They need to have a lot of trust, et cetera, et cetera. And then is it truly locked down, or are there, is it a multi-year contract, but it's easy to get out of? In recurring and non-recurring businesses, if you can demonstrate the year-over-year repeat client sales. So this isn't necessarily true recurring revenue, sort of SaaS revenue-based contractual models. However, you are demonstrating that customers keep coming back, right? And they come back for years and years and years, 10 years, right? Et cetera, et cetera. I still think there's an argument to be able to, if all the other conditions, right? Because it's like a jigsaw puzzle that we got to put together here to get the premium offer in place. If the other pieces within the puzzle are fitting, there's an argument that we can still obtain that premium offer, even if it's not the best of the best contractual, recurring revenue. And then again, there's tons of tech services businesses that just aren't aligned to a recurring revenue model, right? I mean, it is the way it is. As a matter of fact, the vast majority of the market is in a non-recurring revenue model. And so the contracts There's best practices in contracting, but again, we will more point to the historical data that demonstrates real quality of service because you've got customers coming back year after year after year.
Right. Yeah, you absolutely nailed it. That having that those repeat and recurring customers are absolutely going to lead to premium valuations. Having the right paperwork behind it matters, and it especially if you're working, I think, with financial buyers. And when I bring that term financial buyers into the mix, Mike, when you think about the buyer types that are out there, we oftentimes think of financial buyers or strategic buyers. Um, that seems to have a mix on the multiple you may be getting, but also this I think brings up the topic of deal structure. So if you're thinking about, almost anyone could get a huge EBITDA multiple type offer if deal structure is a big factor in here. So Mike, can you just tell me the high levels of how deal structure can start to impact the enterprise value that a firm might be looking for?
Yeah, sure thing, Ryan. So if you can think about, walking a mile in the shoes of a buyer's trying to evaluate risk and the risk of to those cash flows moving forward versus how they structure an offer and a deal. And if you think of the lowest risk opportunity for a buyer, that would be an all cash deal to you as a seller. Um, but they're taking the full risk, weight and risk of that business on. And the fact that, they're trying to architect a return rate would mean typically that there's going to be some level of discount or lower offer applied to that because granted, all M&A comes with risk, but they want to try to mitigate any potential downside should there be some unforeseen issue or skeleton in the closet or a big customer, gives them notice post deal as an example. That's not going to allow them to get to their return rates as quickly as maybe modeled or forecasted. On the other hand, if you have a completely at-risk model for a seller or one that's completely optimized to mitigate the buyer's risk, think 100% earnout type transaction, which they are extremely rare, but do exist. We just got an offer on a client we're bringing to market in that manner, which, by the way, wasn't accepted by our client, but they do occur and occasionally do happen and get accepted. That allows the buyer to, obfuscate almost all of their risk pursuant to the return rate or the payout, because it's tied to specific milestone thresholds of business performance. And in the end, they can pay a lot more, provided the business performs to that level of expectation, because they've just, don't have any risk or very low risk. The reality of the matter is that most offers are somewhere in the middle, right? They include a portion that's cash, a portion that is sort of a risk mitigation play for the buyer. Think of what we'll call earnout or contingent payment on future performance of the business. And sometimes there's other financing vehicles like seller notes, which essentially the seller will provide financing for a portion of the purchase price, but that note is guaranteed. It's just paid out over time, not at the time of close. And so, as you think about all these different components, all of them impact where the valuation should land vis-a-vis the risk profile associated with the revenue moving forward. You hear a common theme there. It's the same as, same impacts as it relates to the offer pursuant to, what historically has business performance look like? How much, customer churn has there been? What percentage do you have in recurring contracts? All those things get back to this fundamental question of, how much risk is being transferred from the seller to the buyer. As you can imagine, as a seller operating the business, you have 100% of the risk associated with that business. Your goal when you sell is to either sell 100% of that risk or on the lion's share of that risk, and then you work through getting paid over time to obfuscate all of the risk once the business is completely sold. And so, all those things, it's sort of the mix and match optimization of the value will impact valuation and will certainly impact premium valuation. I'll put a plug in for having a quality advisor, M&A advisor in your camp, like Revenue Rocket. We know what levers to pull to get to an optimum value based on mix of cash to variable to, gain share or risk-based payment to notes. And being able to having had being a fortunate position that we've negotiated a lot of those, we can bring those key learnings to bear for you.
And I think, Mike, this is a topic we could certainly discuss all day. But if we take a look at the lens of just addressing some of the things now, I think what goes hand in hand with what you just mentioned in deal structure oftentimes is really predicated to the owner's involvement in the business or a management team transition plan. Matt, can you tell me a little bit more about how we call it a selling in or selling out, how that could impact deal terms and getting a premium offer?
Yeah, sure. As Mike talked about, the more flexibility that a seller has, the greater the opportunity to get an optimal, and/or premium offer. In most, if not, I think most cases, if a seller is looking to exit the business completely and decrease their transition time, and that's the term that we use for that is selling out. They're selling and getting out. Then what typically comes along with that is an ask for the highest level of cash at close. To build upon Mike's comments, if the higher the level of the cash at close, the less risk that there is for the seller in that case, the assurance of the cash that is going to be delivered. And so what goes along with that is typically you're not going to be in the premium category from an offer perspective. Correspondingly, if you're selling in, you're rolling equity, you're able to give the buyer some flexibility in terms of management of cash flow in a deal, maybe even agree upon a gain share or an earnout scenario. Well, then you're giving yourself the opportunity to simply through that structure increase the offer. And if you're betting on yourself, which most founder-led businesses have done from the get-go, if you're betting on yourself and you've got confidence in your business and you've got confidence in your team, then certainly a wise move to look at having that flexibility.
Yeah, no, absolutely. So if I was to summarize what I heard today, Mike and Matt, I heard that growth has got to be a feature of the business, and you've got to be growing at more than 10%, ideally higher, or 10, 20, 30%. And that's got to be paired with healthy EBITDA margins that are above 10, 15%, ideally in the 20+%. I heard that you had to have growth functions and staff in order to hit those growth goals. So it can't just be a year of owner-based sales. It probably needs to have a growth function attached to it to help us grow. I heard that having a target market is going to help increase that offer, like get to a premium offer. And I heard that having kind of wider geographies and the ability to serve a wide geographical market can help bring a premium offer. Talked a bit about recurring revenue and getting above 60, 70%. And I heard that repeat revenues really can be looked at as something that can be almost as powerful as recurring revenue if you've got the right buyer in mind. And then I heard that the deal terms are a big part to this. And if you're willing to stay in and work on those deal terms, that can also command a premium offer. Matt, I'll turn it over for you. Any last thoughts? But I guess the one question I have here is, how does working with an M&A advisor help you get to that premium offer? What does the role of a company like Revenue Rocket play to help establish all the things we talked about?
Yeah, well, in our case, I think there's a few different ways. We've been there. We got into this business of helping other businesses like the ones that we used to run. And so, we've been in these seats and we've seen it. And I think that that's super important. The first way that we can help is we can help a firm for literally years before it is their time to help them optimize, to help them increase their growth rates, to help them ready their business for that optimal exit. And that's not a 2-week, 2-month process, really. I mean, to provide optimization, it takes time to, improve some of these levers. And another example is you can quickly create sort of leading offerings that have value in and of themselves, right? And so, for example, today, creating a leading AI offering is certainly something, but then applying that in the right way to the target market that you are serving today and you are best known in. Again, that's not a 2-week or 2-month process. So there's a variety of different ways in which we help firms, get ready. And I can't advocate enough. As a matter of fact, I had a conversation just last week with a former CEO who was, sort of, he was like, man, I wish I would have taken a little bit more time and I wish I would have gotten more help from the outside. And so, really can't stress that enough. And then, obviously in bringing your company to market and identifying the very best matches, those firms that are going to see the premium value that you bring. In addition to that, running a process that there's the appropriate level of competition, because that matters in helping to ensure, that optimal price point. So certainly a variety of ways over time. And as we've talked about before, find that advisor that really has that expertise in your space.
No, great. Thanks, Matt. Really appreciate the insight here. Mike, I'll turn it over to you for any last thoughts.
Thanks, Ryan. Yeah, I think this is an important topic. I think, for many of you, this has been your life's work. You really do want to take the time to optimize it and get the business in alignment for a premium offer. I think it only makes sense. And certainly we're here to help with that. We've done lots of what we call M&A readiness type of engagements for our clients. And certainly that leads into bringing you to market to get a above market offer. So with that, we'll tie a ribbon on it for this week's Shoot the Moon podcast. Make it a great week. Thanks so much.